Hi friends, in today's edition of Knowledge Series, we will be talking about mutual fund recategorization and how it simplifies decisions for investors. Since 2017 and subsequently, SEBI has come out with several regulations that has impacted the mutual fund industry in a big way. SEBI asks these asset management companies to recategorize each of these schemes as per certain predefined parameters, which has significantly impacted how funds are now being managed. SEBI classified equity into 11 categories, debt into 16 categories, hybrid into 6 categories, 2 solution-oriented categories and 2 other categories. In this edition, we will be focusing on the equity mutual fund recategorization. According to the new set of regulations, now every AMC can have 11 open-ended diversified equity fund categories and one scheme in each of these categories. Now let's understand which are these 11 categories. To start with, there is large cap fund, large and mid cap fund, small cap fund, multi-cap fund, focus fund, value and contra fund, thematic fund, equity linked savings scheme, dividend yield fund, and a recently introduced category is flexi cap fund. SEBI also came out with new set of regulations on the market capitalization cutoffs. For example, earlier each of the fund houses had their own definition of what is a large cap stock, what is a mid cap stock. As per the new regulations, the top 100 stocks by market capitalization is considered as large cap stocks. The 101st to the 250th stock is considered as mid cap stock. Anything beyond 250 on market capitalization is called as small cap stocks. The new guidelines categorically defined investment criteria for each of these 11 categories. For example, for a large cap fund, 80% of the money has to go to large cap stocks, which are the top 100 stocks by market capitalization. For a large and mid cap category, 35% of the money has to go to large cap, 35% of the money has to go to mid cap. For a mid cap fund, 65% of the money has to go to mid cap stocks. For a small cap fund, 65% of the money has to go to small cap stocks. For a multi cap fund, 25% of the money has to go to large cap, 25% of the money has to go to mid cap, and 25% of the money has to go to small cap. The other 6 categories have no restrictions on the market cap allocation for each of these categories. However, for a focus fund, one restriction is that the maximum number of stocks has to be 30. SEBI also rolled out new benchmarks to align to the new categories for suitable benchmarking. For example, they introduced the Nifty Large Mid 250, Nifty Mid Cap 150, Nifty 500 Multi Cap. Another important regulation is that funds will now have to be benchmarked against a TRI, which is called as a Total Return Index, vis-a-vis a PRI, which is called as a Price Return Index, which was the earlier criteria. Now let's understand the difference. Now, for example, if Nifty has given a 10% return in a year, it did not include the dividend declared by the underlying companies in the benchmark. So, if a fund manager was given 14% return during the same period, the absolute alpha was considered as 4%. However, if you include the dividend, which now becomes the TRI, which is the Total Return Index, let's say an annualized dividend of 2%, which means the index has now given 12% return and the fund has given 14% return. So the alpha generated is 2%. That's the fundamental difference between a price return index and a total return index. With this move, SEBI has cleared the clutter of different funds or similar funds with different names, allowing the investors to make a more informed decision and better compare the funds.